Hey everyone, welcome to the KE Report in a daily editorial on Tuesday, September 23rd, chatting with Dave Erfle. Dave is the founder and editor of the Junior Miner Junkie. Dave, as always, let's talk precious metals, gold, silver in particular, because they just keep on running higher. Gold is over $3,800, silver over $44. The stocks, both big and small, continue to outperform the metals too. This is a continuing trend and something that I know a lot of the precious metals investors were waiting for all throughout last year and years before that. So right now, as much as we hear the sector's ready for a break, there should be some sort of correction. I think it really balances out whether you're a trader and you want to try to play that correction, or if you're simply just an investor and you're just riding this long-term wave, maybe just close your eyes and come back in a few months and just see how much higher your stocks are. But what do you take away from the, again, continued strength in gold and silver, the underlying prices?
Yeah, it's what we've been waiting for. I've been saying for the last several years that this move was coming. Of course, I was a lot earlier than expected, and but that's a good thing because my subscribers and I had plenty of time to get into the right companies, accumulate the right companies at the best prices before this move started. And the most difficult part of trying to navigate a bull market like this is having the patience to just sit tight rather than trying to time every short term top, because the weakness in markets like this gets bought quicker and quicker and quicker, and you could throw technicals pretty much out the window on a lot of these stocks. I mean, I thought a month ago we were going to cool off a little bit, and it just keeps going. We talked about several weeks ago about how you should be trimming profits along the way, and I still say that. I mean, this is now a very strong impulse move. I mean, this is one of the strongest impulse, probably the strongest impulse move I've ever been associated with in the sector over the past 20 years. And the most exciting thing about it is the last time we had an impulse move like this, it was off a V bottom back in 2008 after the great financial crisis, right? We had a V bottom and then GDX go up. I think it was like 265% in a couple of years. But if you take a look at the bottoms that these are coming off of, especially if you look at the TSX Venture, right? I mean, that's the most exciting chart to look at right now as far as gold stocks are concerned. Because if you bring up a monthly chart of the venture, and it's got this nearly 2 decade long inverse head and shoulders base, and the neckline is at about 1,000, and it's trading a little over 900 right now, so it hasn't even reached that neckline yet. And if you take a look at where the high was, it was at 3372 way back in 2007 when the gold price was trying to break 1,000. So that's 70% higher. And the longer the base, the higher in space as far as where the end game is in the venture. And I know it's not a perfect barometer because it's only 50% precious metals related juniors, but it's a very sexy chart to look at because even though the gold price is in this runaway market now, kind of like the 70s, where it's nearly reached that 3850 target I've been talking about of the nearly 5 month symmetrical triangle breakout. It's 3850 to 4,000 is the target, and we nearly got in there this morning, and I think December gold got to 3825. But we look at the gold stocks, they still have a lot of catching up to do. I mean, if you take a look at even the GDX, it finally broke above its all-time high at 67, and now that's become support. It came down and tested it really quickly and shot right back up again to make another all-time high. So it's really exciting right now for the holders of gold stocks. But as far as buying more, I don't think I would be buying more gold stocks right here. I'd be waiting for a correction that is bound to come pretty soon.
Well, Dave, just on that last point you just made about maybe not backing up the truck here after such big runs, but there's still the undervaluation of the stocks. It puts investors that are on the sidelines with cash or looking to deploy in a bit of a pickle here because if everybody's waiting for the pullback, could we see some buying exhaustion here where we finally do start rolling over? Or if these things are still undervalued, should people just bite the bullet and start scaling into these because a lot of the development companies are still being valued at 40, 60, $80 an ounce in the ground, while the producer margins are about $1,500 to $2,000 an ounce, pulling it out of the ground. So, do you think there's still some room to close the gap here for investors looking to deploy, or should everybody wait for the pullback?
Oh yeah, I mean, buying opportunities are still going to happen, of course, but they're probably going to be less frequent and they're going to be a lot more violent. So, you're going to see these stocks get really overbought technically, and they might have like these short, sharp moves down. And but they're going to be bought quickly because, like I said before, I mean, there's still a lot of people on the sidelines waiting to get in here. And if we're talking about juniors in relation to what I just said about the venture and where it sits technically, I mean, when I first got into this sector and experienced the last top in 2010, 2011, I mean, companies were being bought for $1,000, $1,200 an ounce in the ground. And a lot of these companies now that have these fantastic economic studies that show really high margins at $2,000 and below. I mean, a lot of these companies have used $2,000 as their base case for these economic studies, and gold is nearly double that. And some of them are trading at $100 an ounce and or less in the ground. So they still got a lot of catching up to do. So if you take a look at the charts, you say to yourself, wow, look at that thing. It's vertical. It's a rhino horn. I don't want to buy that. But if you look at the valuation, it's still cheap. So yeah, I mean, you just got to hold your nose and buy weakness on some of these things. But it is difficult, especially if you've been in the sector a while and you're used to getting creamed right after you buy something that's run up so much. But I mean, as far as the valuation, you want to look at the valuation of the stock, especially in relation to peers, because a lot of these juniors are still trading, a lot cheaper than their peers, even though their stocks have moved up so much recently.
Dave, let's dive into that a little bit more because I was going to ask you, since all these stocks, or let's say 90 to 95% of the precious metals stocks are moving up together, which sector of stocks have the most upside? Still sounds like you're looking at some of these ounces in the ground, resources, whether we want to call them development or whether they're simply just the underlying value of that resource. By looking at market cap, the valuation, then you really are just carrying that over to what the ounces in the ground are getting valued at. What's a reasonable level for valuations? Because it wasn't long ago we were talking about $10 to $20 an ounce in the ground. Now everything is 30, 40, 50, if not higher dollars per ounce in the ground. So what's your barometer of where you see still the most, I guess, potential upside from here?
Well, as far as personally, fortunately for myself and my subscribers, we got into a lot of these companies really early. So now I'm looking down the higher risk food chain in the earlier stage companies. I think there's a lot more value there, but it's a lot higher risk. But this is the type of market where you feel safer taking higher risk. But as far as your question about what to look for, you want to look at jurisdictions first and management teams, jurisdictions and management teams, and the size of the project and the size of the share structure also.
More so dollars of ounces in the ground. If we're talking valuation, then ounces in the ground, how much should they be valued for?
Well, like I said, it depends on jurisdiction. I mean, if you're in a higher risk jurisdiction, your ounces in the ground are going to go for a lot less. But if you're in a top tier jurisdiction, the ounces are going to go for a lot more. But I would still be looking for anything under $100 an ounce.
Well, Dave, just to that point, we've talked about this probably until we're blue in the face, but you already mentioned it that a lot of the slide decks and corporate presentations, they're still using assumptions of the metals for a base case of 1,800 to 2,400. A lot are above 2,000, but there's a huge gulf between where their base case is and where the company valuations are. I continue to still see slide decks that have the upside case as $3,000 gold or $3,500 gold maybe on their sensitivities table. I mean, that's still way below where we're at today at $3,800 gold. So their upside cases are actually downside cases from here. How do investors parse this out and value things at the spot market?
Yeah, I mean, it's difficult, but you also have to figure in permitting too. I mean, if you take a look at West African companies, right, de-risking projects, on the one hand, it's higher risk because they're in West Africa where there's a lot of more geopolitical situations going on. But on the permitting front, all the permitting is really easy in these West African countries. But as far as permitting in these top tier jurisdictions, especially in North America, it still takes a long time to get a mine permitted. But it is getting better with the administrations in place in Canada and the US. They're starting to fast track these things, and they're starting to look at ways that they can lower permitting timeframes, which is good, but they're still extended, you know. So I mean, that's another thing you gotta focus on is permitting timelines. If a company is de-risking a project and they're not going to have the project fully permitted until 2029 or 2030, their ounces in the ground are going for cheaper as well.
Dave, what about resource size then? Because as we've said a number of times too, 1 million ounces just doesn't carry that same clout that it did 10, 15 years ago. A lot of resources are out there. And yes, again, a lot of these resources are getting revalued. But the big question is, at least for me, what I was asking people in Beaver Creek was, fine, you have these resources. A, how quickly can you get it into production if you are going to be a development play? Or is it big enough that somebody will buy it? So, what's your baseline level for a resource?
Yeah, I mean, I have to see, if they've got a 1 million ounce resource or a 2 million ounce resource, that's fine with me. If I see upside potential, if I'm convinced that they're convinced that they can show proof of concept that this thing can get much bigger, then earlier stage, a 1 million ounce resource is fine with me. But it has to be on a district scale sized land package. And I mean, I also have to see the possibility for much bigger upside.
Yeah, it seems like there's a lot of multi-million ounce deposits now, so 1 million ounces isn't what it used to be. But I'm going to circle back up the food chain one more time to the producers, Dave, because a lot of people are saying, let's sell the producers, buy the developers and explorers. But I've got to ask the question again, based on where these Q3 numbers are, record average gold price, record average silver price, substantially higher than Q2. Do you think that we've already seen the markets price in these latest moves just how well these producers are going to be doing from a revenue generation basis?
I think they're beginning to be priced in, but I don't think they're there yet. Let's take a look at Newmont, for example. That's the best base case to use. Is they're basically the barometer for gold stocks to use because they're by far the largest producer. And last quarter, they showed 1.7 billion in free cash flow. The quarter before was 1.5 billion in free cash flow. And each quarter now, the gold price is going up $300-400 higher than the quarter before. So if we take a look at Newmont's stock, if you bring up a monthly chart of Newmont, I've been saying for a while now that the stock was breaking out of this inverse head and shoulders base, and the neckline was the all-time high at 77, and it just blew through that. And now it's at 85. I mean, Newmont, I think, is up 120% on the year, and that's the only S&P 500 stock, and it's outpaced by far every other S&P 500 stock. I mean, it's the largest gainer, and it still has little fanfare on CNBC and Barron's and the mainstream media. They're really not talking about it much because, lo and behold, the Nasdaq is also making all-time highs. So they're still concentrating on tech stocks, on AI stocks, and gold stocks really aren't getting as much attention as the gold price now. So you're starting to see the press talk about gold being at all-time highs, and silver starting to catch up, but gold stocks really are still not talked about much. So if like I said, you take a look at Newmont, it just blew past its all-time high, and when it reached its all-time high back in 2022, gold was attempting to get above $2,000 an ounce. And I know you got to factor in the dilution of the Newcrest merger, and the fact that they've sold a lot of their higher cost mines, but they're lean and mean now, and they basically got 10 major top tier gold mines. And like I said, I wouldn't be surprised if they cash flow $2 billion in Q3, and that's a run rate of what, $8 billion per year. So that is quite impressive, because gold stocks before, they've always been risky investments. They had a lot of debt. You never knew what the gold price was going to do. But now they're still catching up to the gold price. They've still got a long way to go. I mean, sure, short term, be careful. There's going to be some volatility because they're getting really technically extreme overbought. But like I said, I think there's still a lot of people on the sidelines waiting to get into gold stocks. I mean, I think on Friday, the GLD saw 2.2 billion of inflows in one day.
Yeah, that's the thing. Investors are starting to move into the sector, and they are really starting to go now into the equities. And look, they're having a lot of inflows into the gold-backed ETFs for a while now. So I do think investors are taking note. But Dave, that big question is, when a slowdown happens, when a correction happens, do you think it'll be led by the metals price moving lower, or will the stocks tell us beforehand that that slowdown is happening?
Yeah, they usually do, right? I mean, the stocks usually tell us in both directions. Whenever the gold price, if the gold price is searching out a bottom, and the gold stocks start to move higher before the gold price, the gold price is going to follow. And it usually happens the opposite direction in the miners. The miners usually show signs of a topping pattern, or topping out before the gold price does. So, we started to see that last week. I think it was on Tuesday, right before the Fed, gold stocks were sold, even though gold and silver were up. But it proved to be a very short-term buying opportunity, as by Friday, after the buy the rumor, sell the fact of the Fed easing 25 basis points, which is what everybody expected, and Powell poo-pooing a 50 basis point cut in his press conference. That's what sold off the gold price, and the gold stocks sold off a little more. But by Friday, man, oh man, they came right back with a vengeance and had a huge end of the week, and then a huge start of the week on Monday.
All right, Dave, we'll wrap it up here. Again, full on bull market. Enjoy it, embrace it for all the investors like us that have been in this sector for a long time. Who knows how high this is all going to go, but I think right now you really need to kind of self-reflect. Are you a trader? Do you want to actively trade in and out of these, or are you now a long-term holder? Because depending on what you are there, I think you take a different strategy into really how you manage your portfolio. The long-term holder, just sit tight and wait until we truly see some signs of a maybe long-term top. For the trader, always opportunities, especially within the stocks, to reposition your portfolio, because we are continuing to see so many of these stocks, all of the stocks really outperform, just in different degrees. Again, Dave Erfle, founder and editor of the Junior Miner Junkie. Click the link in the show notes to follow along with Dave and subscribe to his newsletter. Dave, thanks for your time. Have a great rest of your week.
Thanks, guys. You too.